FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
This episode of the Financial Survival Network is brought to you in part by Sandstorm Gold Royalties. Sandstorm Gold Royalties is a different kind of gold company. They purchase royalties on select mining operations and receive a percentage of the revenue in return. Sandstorm now has a portfolio of over 185 gold royalties around the world. See how gold royalties differ from other gold mining investments at sandstormgold.com. That's sandstormgold.com. Sandstorm Gold Royalties trades on the TSX as SSL and on the New York Stock Exchange American as SAND.
Welcome, and you are listening to the Financial Survival Network. It's 12/18/18. Just 13 days left to this year. If you've been following volatile markets, crazy, some might believe that the stock markets are going higher. They could very well go higher. You just never know if Senor Trump can pull a rabbit out of the hat. But that doesn't mean you shouldn't be looking at precious metals and other alternative investments. That's for sure. Good friend of the show. Haven't had him on in a while, but he's back now. Todd Bubba Horowitz is with us now. Hey, Todd, great to have you back on.
It's great to be here, Kerry. And of course, can Trump pull a rabbit? I don't think so. The markets are at the stage, in my opinion, that there ain't no more rabbits. The rabbits have gone.
Hey, and by the way, if any of you out there want to participate in the show, just email us kl@kerrylutz.com. So, Todd, we're looking at what the stock market's doing. You know, it's down a bit, up a little bit today. What's your feeling on the stock market?
I think the markets are going significantly lower, Kerry. I mean, there will be some rallies again. You know, I think one thing that investors and traders alike should recognize is that the best rallies come in bear markets. They're vicious, they're fast. Those are the rallies that as a trader, you can't wait to sell because they typically fail. I mean, even if you've seen the last couple of days, we had these big ups and then the next thing you know, they're down. And that's the signal that we are in a bear market. And I think there is a lot of room to go on the downside. And with the Fed coming up tomorrow, there's going to be, no matter what they do, I don't think they can make the right decision. I think they've backed themselves and painted themselves into a corner. And I think that the markets, they're going to get an initial pop because everybody's looking for Santa Claus to show up in these markets. But after that, I think we have a dramatic amount of downside risk here. And I'm not talking about 4 or 5 more percent. I'm talking about 10 to 20 more percent before I think we will find a bottom.
So you think that the downside, a lot more potential on the downside than on the upside. But, you know, stock markets do climb on a wall of worry. And we've got a wall the size of Trump's proposed wall of worry in the marketplace all over the world. What do you think is bringing it down here? Is it the debt? Is it the poor performance of these companies that have been doing nothing but buying their shares back to inflate their per share earnings? What is the underlying problem?
It could be all the above, but let's go to the basic simple math. Okay. Companies have had record profits for years, and they've had it because the money has been too cheap and because they were able to take advantage of very cheap labor costs. Because for years, you know, when the employees were in control and there wasn't a big when there was not a big labor base or a big demand for jobs, now there's more people that need jobs. There's more jobs available than people that need them. So it's increased the labor because you've already seen Amazon go to $15 an hour voluntarily. You're seeing McDonald's go up. All these companies are paying more payroll. Well, that's coming right off the bottom line. We can try to ignore it, but again, these big numbers that we're used to are going to disappear. You measure in now higher interest rates, and I don't care what the rates are doing right now. They've been coming down recently because of a lot of fear. We look at this as a they call it the fear trade. People are buying bonds, but in the meantime, rates want to go higher. Fixed income is the biggest market in the world by at least 10 times, if not bigger. The fixed income market is actually as big and can take on the Federal Reserve. And the fixed income market is actually what's been forcing the Fed to push rates higher, and they are not going to stop now. So although we have a temporary pullback in rates, and the 10-year was about 320, now it's back under 3, it's about 280. I see the 10-year at 4% sometime mid next year. And that, of course, goes again right to the bottom line of corporate profits. So from a fundamental standpoint, you've got those things to worry about. Now, from a technical standpoint, the markets are breaking down. So all of these reasons will, in my mind, put these markets in a severe world of hurt. And I think they do continue lower. And again, I'm only a seller of rallies right now until the pattern changes. Right now, the pattern in all these big tech stocks and the pattern in the markets is lower. The Russell's getting clobbered every day, which is the biggest key to this, because the Russell is truly the index of risk on, and nobody wants any risk right now.
Yeah, so we're in risk off, and there's a limit to the benefits of what is it going to say, of leverage, right? Have we reached the end of what debt can do for companies?
I think so. I think that one of the things you have to look at is that, if rates go higher, okay, then, it's going to cost the bottom line. It's going to change the dynamics. You're already seeing it in the housing. And I happen to believe, and I have no proof of this, I have no evidence, but I happen to believe that the banks are in just as much trouble today as they were in 2008. And it's being ignored because I know a lot of these smaller lenders that do a lot of financing, and they're not predatory lenders, but they're higher rate lenders. And, and you've got Prosper and all these peer-to-peer lenders. And I happen to know that the banks are buying up these loans like they're free.
I know.
And to me, that is not a healthy situation. So when you look at the big picture, I think you mentioned debt earlier. I mean, we've got massive amounts of margin debt, student loan debt, auto debt, not to mention government debt. So the debt is ridiculous. And of course, the actual other part is the suppression of the U.S. dollar. The Fed has tried to keep the dollar down. For us, it doesn't matter because the rate is the rate. But when all these emerging markets were borrowing money based on a cheaper dollar, well, now that 2% rate that they got is really now like 4%. So it's causing a lot of heartburn around the world.
Yeah. Well, all you're saying is definitely correct. But by all rights, the market shouldn't have really been going up based upon economic performance of companies around the globe, right?
No, of course not. But again, remember, the markets and the economy have nothing to do with each other. But of course, you had a bunch of people that were listen, cheap money. If I can buy my stock back and pay 3% instead of the 4% dividend, I'm going to buy my stock back. If I know that I can create 10% return on investment for every dollar of cash I bring in, I can borrow at 3. I'm going to make that trade. So again, we got into the usual mess with the bubble creators from the Federal Reserve. That is always one of the big issues that we have to remember. I mean, Greenspan said this morning that the party's over. Now, again, he was the big bubble builder to begin with. He's the original bubble builder.
For sure. Couldn't agree with you more there. He was the master illusionist, right?
That's my opinion. Again, he built the original bubble. I mean, when I first started actually trading, Treasury bonds were about 50 points or whatever it was. Now they're 140. So again, this is a ridiculous situation that we let continue to happen. And until we put some restraint on the Fed, which obviously I don't see happening, unfortunately, because all they do is seek and destroy, I think we've got a bigger problem.
Yeah, so we've got a bad problem here. We've got really nobody addressing the debt issue. The debt continues to increase at a geometric pace. We've got the inability to govern, and we've got chaos around the world. And really, is it cyclical, or is it just a question of that's kind of the way we do things now?
Well, I think that this has kind of been the way we've done it since 1980 anyways. I mean, I am a believer in the equity markets in the long term. I mean, I do hedge my own portfolio. I don't get out, but I do believe in that the markets do go up 8% year over year, no matter how much they try to mess with it. But there are very big and severe declines, and I think we're starting to see the smell of that now. And again, you've heard people talk about the cyclical bull market. It's going to last another 20 years. Well, again, these are the same guys that were telling you to buy in 2008. These are the guys like Jim Cramer saying Bear Stearns is fine, buy him. And of course, they went out of business on that Monday.
Yeah,
so again, I look at all these things and say, look, these guys have a reason to want you to be in the market because that's where they make their commission. At the end of the day, these markets are ugly right now. Again, could it turn around and could they find a new base and level? Sure, they could. I can't say how far. I'm never going to make a dramatic call. I mean, I have a number in my mind, which I would never repeat to anybody, of where I think we're going before it's all said and done. But it's I tell you, it's significantly lower than where we are now. Significantly lower.
Yeah, well, I don't doubt it for a moment. And yet somehow the U.S. has continued growing through thick and thin. Can that continue, or are we just going to go to a major recession here?
Oh, I think there's a recession coming for sure. There's no doubt. Now, the real truth, Kerry, is there's nothing wrong with a good recession. Mm-hmm. The problem is when you have somebody trying to manipulate around that recession and avoid it. It's a lot easier if you would just take it on head on and adjust to what's going on instead of trying to prevent it. We know they can't be prevented. Who are we kidding? This is the same as John Maynard Keynes said in 1928, that there'll be no more crashes in our time. And of course, Janet Yellen in 2017 said the same exact words. There's no way you can avoid a financial downturn in any market. That's the way markets truly work. That's the way the economy truly works. So it cannot be avoided.
Can't be avoided. So we just have to, and they're good too. Recessions are good because they get rid of excess speculation. I mean, when you look, Todd, at the speculation that we've had over the past, 10 years with free money and everything else, it's been madness, hasn't it?
It has been madness 100%. Again, this is the old story, right? What we always hear, the rich get richer no matter what goes on in the market. And that's because the average guy could not take advantage of the cheap money. Okay. Sure. The average guy couldn't get money. Banks wouldn't even lend to him for a while.
Right.
So the big guys who get all they want were sucking up all these assets, at reduced values. You remember It's a Wonderful Life? Yeah. Mr. Potter isn't selling, Mr. Potter is buying. And that's what's happening for the last 10 years. That is what has happened in this market. Mr. Potter continued to accumulate wealth while the rest of the middle class struggle.
Yeah, and that's exactly what's happened here for sure, Todd. So what is Joe Sixpack supposed to do here? How does Joe Sixpack get out of this intact, or maybe even turn a profit from it?
Well, there's many ways to do it. Joe Sixpack, if he's in the market, should be hedged. There are many ways to use derivatives to hedge your portfolio, which is what I teach and what I do. So you don't have to take the massive amount of risk. The other thing Joe Sixpack has to do is not be over leveraged to the market. If you're invested with money, you don't need to pay the rent. You don't need to pay the mortgage. You don't need for the car payment. Then don't worry about it. Turn off the phone and quit looking at your 401k every day. Because again, I'm a believer that if you're in strong companies, that they will turn around. So I wouldn't worry. Again, I'd never be happy about the markets going lower, but typically, if you are an investor only and you're continuing to invest, you buy highs, you buy lows. At the end of the day, markets do move higher. That's my opinion. That's how I always had traded it. Of course, then I became a master hedger and understand how to use derivatives to actually prosper and compound my own portfolio. But at the end of the day, I would, as long as you are invested with money that you don't need tomorrow or the next day, and you're not going to need it to pay your car or rent, then you should certainly not panic and look for new opportunities when we get a little bit lower.
Yeah. So hedging, that sounds like it requires the use of options, perhaps futures. Joe Sixpack's a little scared of that, isn't he?
Some of them are. I mean, again, listen, we can always be afraid because, unfortunately, we are taught by the media to be afraid of things when, in fact, there's nothing to be afraid of. I mean, anything that you can use a mathematical equation to make a decision on is the thing that should be for everybody. And that's what options do. If you learn to understand them, that's what options do. They create the opportunity to do exactly what you need to do to protect your portfolio. And again, there's things you can do that just are so easy for the average person to do if they want to stay in the market. But the biggest thing I will tell everybody is before you panic, or as we say on the trading floor, puke it out, take a deep breath and make sure that is your final decision. Because one of the examples I like to use with all my people is Have you ever said something to somebody that the minute those words came out of your mouth, you wish you could put them back in?
Yeah.
That's the same thing that happens in the stock market. You do something and you wish you had done it. And I think just take a deep breath. As I say, take a chill pill.
Yeah. So as a trader, though, you have to deal with emotions. I mean, your emotions can often be your enemy, and they can sabotage you and cause you substantial losses. How do you tell Joe Sixpack how he controls his emotions and doesn't get sidetracked by them?
Well, again, that's the billion-dollar question, but I think that you just have to understand, if you believe in just basic math numbers, okay? Mm-hmm. So if we go back to the original comment I made, the market goes up an average of 8% year over year. So if you believe in that, and again, that typically most people don't panic until they're extremely invested. And of course, unfortunately, in today's world, because of the low interest rates, because you can't get any money from the bank when you make a deposit, many people are over leveraged to the stock market. So what the average investor should do, if they are concerned, is not wait until it's too late to get out, but take some off the table today. If you're concerned, again, I am personally not concerned. And of course, I'm hedged too. But even if I was not hedged, I would not be worried. But I would say that if you are concerned and you have a tendency to get emotional or potentially panic, then the best thing to do is take some of the money now and put it in your pocket. Because certainly in most of these equities, after a 10-year bull market, you have to have some pretty good profits.
Hey, and that if you manage to get back into the market, but many of you out there didn't. What about real estate? Do you have any particular feelings about where that's heading?
You know what, Kerry? I like real estate. I'm invested in real estate, but my 90% of my money goes into the equity market because I can control it, I can hedge it, and I can protect it. But I think real estate's a great investment. Listen, I own a house, I own some other properties. But again, obviously for pure appreciation, there's nothing like equities. But for a little bit of safety, you want peace of mind, you want a hard piece of land or property it may go down in value, but if you're renting it out, it's still collecting rent. If something changes, at least you own an asset. That you asked about the debt. And I just wanted to go off topic 1 second here, but the debt that we had in 2008 was all housing and property, basically, which at least the banks had some collateral that had a chance. Today's debt is all air. It's student debt, auto loan. Those are worth nothing. So they're never going to come out. And I do like gold as well. I think everybody should have some representation of gold in their portfolio, whether it be 5 or 10%. I think that, again, it's a good, hard asset. And I think good, hard assets that you can touch, you can feel, you can smell are good to own. And so I think that should be, part of everybody's portfolio, because I think they are both solid growth assets that over time, like the markets, will grow.
Mm-hmm. Hey, and just revisiting what the Fed is going to do this week, and they're kind of damned if they do, damned if they don't, because if they don't raise rates, then that's going to be a signal to everybody that rates are going to go drop. They're going to be cutting rates perhaps, or it's that they don't know what to do. And if they raise them, and it drives the market down further, well, perhaps the market's already discounted that possibility. Whatever they do is the wrong move here.
That's my opinion. Again, they have butchered this whole thing. They've painted themselves into a corner, and there's nothing they're going to be able to do about it. So whatever they do, when the decision comes out, there's even talk they might only raise an eighth. Okay. And everybody wants to hear what they say, how dovish they're going to be. But the more dovish they become, the more trouble I think it means that we're actually in. So again, if the market, if the economy and everything is as good as everybody says it is, then we should have no reason that rates should not be higher. Okay. I mean, that's very simple. There's a demand for money. And one of the problems when you manipulate rates and you manipulate currency, it means you're taking away the true price discovery model out. And I think that's the mistake that they made.
Yeah, so markets are supposed to be about price discovery, not about manipulating the public's belief or their expectations or their views of the economy. But that's what they've turned into, right? They become like these billboards of everything is fine, don't worry about it, just keep doing what you're doing.
Well, I mean, again, they basically, if you believe in The Creature from Jekyll Island, which was a book that was written on the Fed, and that's where the Fed was created. I mean, basically, all they've done is destruct the dollar since 1905. Again, I don't think they're a necessary evil. I think they're just evil for what they do. I don't like the action, and I don't like the name, which makes people think that they're a government agency when they're not. They're really just controlled by the banks. And of course, if you go back to 2008. If it was me, I'd have let the banks go out of business and just make the depositors whole. If I would have taken that Fed money and instead of giving it to the banks so they go out and pay themselves bonuses and take all the care of that business, I just said, okay, you're a depositor in this bank. We're going to give you all your money back and you can go to a new bank. Because again, I think we rewarded an organization who was very closely tied to the Federal Reserve with bonuses when they actually caused the problem by giving out loans that had no value.
Yeah, and we left the same people running these banks that caused the problem in the first place. Your Jamie Dimons of the world. And where has that gotten us? These banks have become even more too big to fail. We just have less banks, more concentrated financial sector, and the economy should be diversified away from the financial sector. I think we all agree on that. And yet it's become this huge tail wagging the dog of the economy, if you will.
I couldn't agree with you more. Look, again, this is it's my opinion. I'm not an economist. I'm just a guy that lives on the street. I'm a street kid. I have common sense. And unfortunately, the people that run the Federal Reserve, although Powell has a little bit of smarts, but they're smart people. I mean, listen, they're very high degree people and they're very intelligent, but you cannot run anything on academia. If your station breaks down, Kerry, what do? Do you wait for the manual to come out so you can figure out how to fix it? You figure out how to try to get it done and fix it. Yeah. And that's the problem that I have with the Fed is that it has to be by their books, and they can't tell me until 10 years from now whether or not this was a recessionary period. Now, if you truly know what's going on, you should be able to tell me that we are in a recession, because that's what I think we are.
Yeah. Hey, and then when you look at the price of oil. All right, it was up to 75. Now it's below 50 today.
Yes,
that can't be the sign of a healthy world economy, can it?
Well, I'll take the other side of it. I first of all have been on air all over the place when oil was 70 and everybody's saying it's going to 100. It's going higher. I said it's going into the 40s. Okay, we're now in the 40s. I think now it's got a chance to go into the 30s. When I grew up, well, you're the same age as I am. When we grew up, oil was $12 a barrel, and we were very prosperous as a nation. I don't agree that it's a sign of the economy. I think it's agree that we now have the ability to put so much more oil in the system because we actually ourselves are one of the number one producers in the world. So we've got such a supply. Why should oil be higher? And it's obvious that the frackers are making money or they wouldn't keep putting up rigs. Yeah, so again, I go back to, hey, the markets are the markets, and the markets will always tell you what the facts should be. And the facts are, is oil's going lower, and I think it's going a lot lower.
Yeah. So bad for the banks, though. Bad for the oil companies. Bad for Venezuela. Bad for Iran. Bad for Saudi Arabia. Bad for Russia. But good for the consumer, right?
Good for the consumer. Good for the frackers of the United States of America. Good for the U.S. of A. Okay, I don't care about Iran and their oil, and I don't care about Russia and their oil, because for years, OPEC has held us up. I don't know if you go back and remember the times when they created those oil shortages. I was pumping gas when gas was 29 cents a gallon. Okay, and I remember the first time it went to 50 or 60, and everybody almost had a nervous breakdown. And then when it went to $1, and you had to have alternate days and when you could fill up. I mean, it was a joke. So I remember when OPEC tried to manhandle the United States of America. And again, I'm thrilled that we don't need them, and they are basically just a worthless organization that has no value other than to try to hold up the individuals.
Yeah. So, like you said, Todd, they don't know we're in a recession until 3 years after we're into it. And then they say, oh, yeah, by the way, we've been in a recession. So is it possible we're in a recession now, or we're just peaking? Because when you look at the employment numbers, they've all been monkeyed with. But the one number they really can't or haven't monkeyed with is new claims for unemployment insurance. Those are at generational lows. So there's got to be some improvement in employment. But does that set us up for really being at peak now and looking forward to the next recession?
I think we're probably peaking. Again, are we in a recession right today? Possibly. I mean, but again, I think the markets will tell more of the story. Remember, the economy and the markets are really not that related because the stock market supposedly thinks about 6 months to 9 months in advance. So if that is the case, then 6 months from 9 months from now, I think we'll start to go into recession. Nobody sees a recession in 2019, but I do. I see a lot of issues coming to the table. I see a lot of problems coming to the table. And I think that this is going to be fairly ugly when it's all said and done. And I think it would not be surprising if we saw 2008, 2009 recreated. You know, again, I see a lot of issues out there, and I see a lot of people, just like if you remember the 90s, Kerry, when the internet bubble was here, and all these guys were making so much money trying to day trade stocks, and they were taking up big profits. But what happened is, once it was over, they all lost their money, and then they had to pay taxes on the money they'd already spent. So again, I could see a much bigger problem down the road.
Yeah, for sure. And we just keep kicking that can further and further down the road and just saying the future will take care of itself. You know, who was it? Yogi Berra, who said prediction is very tough, especially about the future. So it's definitely getting interesting out there. So, Todd, we find you at BubbaTrading.com?
Yes, BubbaTrading.com.
And, hey, want to find out more about you? Any way for people to connect with you on the web?
Absolutely. They can email me direct at Bubba@BubbaTrading.com. I'd love to hear from you, and I answer any question. I do a lot of webinars that help teach as well. So certainly reach out to me anytime you'd like.
Hey, and you have a webinar coming up in very shortly, don't you?
Yes, I do. I'm going to do a webinar on building a trading plan for 2019, because one thing we all know is that there's many different ways to trade. And each type of trading you do has to have a different plan, because the results and the actions are always different.
Hey, so always got to have a plan, although like Mike Tyson says, a plan lasts until you get hit in the head, right? But then you revamp your plan and you move ahead. I think that's the best thing to do. So, hey, any questions for Bubba, myself, just email us, kl@kerrylutz.com. If you're listening on YouTube, then please subscribe, like, and share the show. And if you're just listening to the show, share it with a friend. Really appreciate it. Really helps a lot. And you can check out our Twitter feed at Kerry Lutz, our Facebook page, Financial Survival Network. We're looking at other platforms now because those are being censored right and left, and we want to try to avoid censorship wherever possible. Todd, it's great talking to you again, reconnecting and getting your view on things. We'll definitely talk to you again soon. Be well.
Thanks, Kerry. Happy holidays, man.
Hey, you too. Happy and a healthy new year to you and yours.
Thank you, brother. Appreciate it.
FSN Radio. It's all about what's next. Go to FinancialSurvivalNetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.